Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is our special edition of Market Masters. On the show today, we will be inviting one of the top voices of stock markets, and of course at a time when everybody is putting their heads together to really find out what could be the outcome of the Indo-Pak geopolitical tensions that are on the rise and what could that mean for the stock markets at large. That's what we're going to be understanding, and of course all the aspects of the markets as investors that you need to know. Let us put our hands together to welcome Gautam Shah, founder of Goldilocks Global Research now. He's now joining in on the program with us. Warm welcome to you, Gautam. Good to have you with us, and congratulations on this new defined firm that you have, which is a global research firm. We will talk about it as well, but just like I gave the intro, and how most of our viewers have seen you on the thumb talk about, I think that's the biggest question. We have been seeing recovery at large in the Indian stock markets from the 1 week, 10 days of losses that we saw, and there has been a smart recovery. FIIs are coming back. There are things softening down on the tariff front, but back home, closer to home, we have these geopolitical tensions afresh that are surging at this point in time, giving us a lot of uncertainty at that time as well, as to we do not know how are things going to finally take shape, what's going to happen. What do you think that Indian investors must know as they go on to invest in the Indian stock markets amidst these newfound uncertainties?
Good afternoon, Sakshi, and thanks for having me. Well, I think the markets understand geopolitics best. I mean, in the last couple of years, you had some very important geopolitical developments, and everybody was scared how the world is going to shape up and how stock markets would shape up. We saw all of it happen with Middle East and Russia and China and the US involved. But I think at the end of the day, the markets actually was the best judge and told you that all was quite well. In fact, I've been seeing this for the last 22, 23 years. I still remember September 11, 2001. And 10 days after September 11, when the US decided that they need to attack, was the day the stock markets bottomed out. And so this has happened a few times in the last 20, 25 years. In the current situation, obviously, is extremely fluid. Nobody has a clue as to how this is going to shape up. This is a risk that we have been living with for a couple of decades now as a market participant. And you really cannot do much and you cannot overanalyze. But since I believe that the price action is the best judge, I think the way the markets have come back today and the kind of calmness which is there on the screen in some sense, and the fact that India VIX hasn't really seen a very large move, I want to believe that a lot of uncertainty is already in the price. So I wouldn't be too negative. Yes, if you're somebody who's into leverage trading and is looking at the markets on a day-to-day basis, this might not be a good time to be adventurous with longs. But if you're somebody looking at a 3, 6, 12-month perspective, I think the recent recovery has been fabulous. The India story continues. And I think these developments around geopolitics generally have given you an opportunity to buy in the past. Even if there is an adverse condition, I don't think it's going to be long drawn because the market will discount it really fast. So purely based on price action, I would be positive, I would be constructive, and I think this number of 23,800 on the Nifty is important, and I'm inclined to believe that you're going to see a lot more upside over the next 6 to 12 months.
Okay, so we are actually headed for a lot of upside over the course. Even if there is a sharp volatility because of any actions, the recovery could be much faster. What does that mean for an average investor? Should one continue with their SIPs on the Nifty and the Nifty Bank? What should one do really? Should one really focus on stock specifics rather than the index at this point? What would be the ideal way then?
See, a month back, the same question was asked when the Nifty was at a level of 21,800, whether you should continue with SIPs or not.
Correct.
Obviously, there was one section of the market which believed that this is a local problem and it would take 6 months, 12 months, 18 months to clear out. But the market has shown us that it's incredibly resilient. And the money which was at the sidelines on the first signs of global stability came in, and that really triggered this 2,500 point move on the Nifty, which actually caught a lot of people by surprise. So I think with SIPs, you simply stay invested. These events around earnings and geopolitics, et cetera, I think they keep coming and going, but they just give you opportunity. So as long-term investors, actually, it's just a pass. You don't do much, you don't overanalyze, and you just stay in the game. But the key point is stick to quality. Because, in case there is an adverse development, it's grade B, C, and D that will actually see a big move down, maybe temporarily. But grade A stocks, I think, will do well. And we've seen what banks have done. We've seen what NBFCs have done. We've seen the
Yes.
comeback in FMCG and auto. So I think stick to grade A. The current political and economic environment, sticking to top quality is extremely important.
Sticking to top quality, that's the word. If you are in the market, stick with the top quality stocks. And we have seen how large caps have really led this recovery from the front, like you pointed out, from a whole host of sectors. We will come to the sectors also now and understand from you, in the ongoing recovery, like you said, that you are penciling in higher upside from the Nifty over the next 6 months, 1 year perspective. Are there any key sectors or themes that you are betting big on that could lead this recovery from the front?
For the last 3 or 4 months, we've been extremely bullish on financial services, and I think the writing is on the wall. You don't need to be a magician to understand that, because while the markets were correcting, the financial services and the banking stocks were the only ones which were absolutely range bound. I mean, look at what HDFC Bank did when the Nifty went down to that number of 21,800.
Yes.
And as the market stabilized, it's the bank Nifty and the financial services index which just propelled this market higher. And these are companies which have nothing to do with foreign soil. Everything is in India, everything is inclusive. And that's probably the reason I think institutional investors also like to commit into them. And domestic money is anyway pouring into these top 4 or 5 stocks. So I think financial services, according to me, even now, from a charts perspective and from a comfortable valuations perspective and the margin of safety perspective, I think it's going to do bigger things. If you want to talk about numbers, I would want to believe that the bank Nifty is headed towards a level of about 60,000. So there is another 4,000 points to play for. And some of the top stocks are very well placed for greater upside in the days and weeks to come. So this is probably my best bet. Some of the couple of other bets that we like are power and infrastructure. I think they are the India story. They are, stocks and sectors which have done very well, went through a bit of a breather and now coming back. So these two spaces we like as well.
Okay. So since you talked about banks and financials, just taking that follow-up question there, and you did talk about what HDFC Bank did, what ICICI Bank. Most of these banks have also come to their 52-week highs. So even from now, do you think it's a great time to take a fresh entry in some of these large caps?
I think so, because I think the risk reward is justified even at these prices. I mean, that's a great question, because a lot of retail participants find it very difficult to commit capital at these prices. But again, if you look at the valuations, if you look at the relative strength, and if you look at the visibility of earnings over the next few quarters, and given the aggressive stance of the RBI, I want to believe that these top banks will continue to do well. In fact, just one name like Kotak, was an underperformer for about 3 years. No recommendation. It's an observation that after 3 years of underperformance, some of these stocks are coming back very strongly. So I'm still very comfortable with the top 4 in the banking space.
Top 4 in the banking space. PSUs also, would you look at a fresh after the recent consolidation?
I think PSU is a new mega trend, and I think we've been putting it in all our reports in the last 1.5 months. Number one, the ownership is good. There's a lot of domestic ownership. The earning quality has been excellent in the last few quarters. While everybody talked about the India slowdown, if you actually look at the earning quality of PSU stocks, it's been quite good. And these are stocks which are high single digit, low double digit, so very comfortable. You don't need to buy a 50p, 60p, 70p defense railway, paint stock. You can buy a PSU at a 12, 13, 14, 15 PE. So I'm very comfortable with the entire PSU basket. I think the top 7, 8 names, banks, infra, power, energy, all of these stocks I think will stand out, and I think the margin of safety is immense to buy into PSUs. You could in fact even buy an ETF or a basket and play it over the next 12 months.
Okay, an ETF would be a great way to really participate from now onwards as well. So that's a positive. Let's look at the other heavyweight spaces. IT, for instance, there was so much, dichotomy between deciding whether one should go for IT or should avoid IT because of what was happening on the tariff space. From the time that the earnings started to come in, all of the IT spaces, they started to rebound and show us that, inline numbers have come in. Not too much of a pessimism is being seen, even if there is an uncertainty that is being seen as an overhang, but most of the stocks did perform well. How would you look at a fresh on the IT pack, sir?
I would stay away from it.
Okay.
I know they saw a very large fall, 31,500 on the IT index was a very important support, and we've rebounded from there, and we seem to be stabilizing.
Yeah.
But I don't want to jump the gun in believing that this tariff-related news flow coming out of the US is done and dusted. In today's world, you could have anything coming out of anywhere, and any which way you are at a point where the global scenario is still a lot more volatile. So why should I make investing and trading so much complicated when I know that there could be a gap up or a gap down risk, every single day? I would be very comfortable with financial services, power, infra, metals, even for that matter, real estate. IT and pharma and auto, I'm staying away for now because I still feel that there are risks to downside there.
Okay, so export-oriented you would probably reduce, but largely the domestic-oriented themes is what you would look at. Where would you place defense? There are fresh orders that are coming in, Ministry of Defense, and amidst the new, world order that we are seeing at this point in time, how would you look at defense afresh?
Well, it's not surprising that defense stocks have done well today because, again, you just need common sense to say that in current environment, defense stocks will be the fancy of market participants. But I'm not sure whether this is a structural trade. I still feel that defense and railway have played out as a structural trade over the last 2.5 years, and you can't make serious money buying into them over the next 6, 12, 18 months. There could be a trade for the next few weeks, given the current environment and the new breakouts that we've spotted on the short-term charts, but I would still go with some of the other sectors. So don't be in a rush to buy into defense at these prices, and many of these companies are very expensive. So keeping that in mind, I think one needs to be a little conservative.
One needs to be a little conservative. You did talk about metals you're looking at favorably, sir. What are the factors that are giving you the confidence to stay with the metals? They have been very volatile. They have been very cyclical in the past. Again, a lot of ends are tied to what happens globally and in China. What is giving you the confidence to look at metals afresh?
Well, actually, the dots don't join. Because if you try to combine technicals and fundamentals, there is no case to be bullish on metals. But chartically, I want to believe that there is something behind the scenes which maybe the market doesn't know, which price action knows, which tells us that metals as a pack could do very well over the next 6 to 12 months. I love the way some of the top stocks came back. I mean, look at the comeback in Tata Steel, JSW Steel, JSPL, Hindalco from lower levels. And I think the overall structure remains quite positive. So in our recent reports, we actually gave out a big target of about 10,000 on the metals index. So that's a good 1,300 points away from where we are right now. I think the fundamental triggers will follow. But I think the China plus one trade and the tariff-related news flow getting digested is the key positive. And many of these metals companies are at very good valuations. I mean, look at the valuations of an Hindalco or a JSPL, and you will realize, or even a Tata Steel or a SAIL for that matter, you'll realize that the margin of safety is immense. So once the global situation stabilizes, I think metals will come back very strongly.
Metals will come back very strongly. Another space that I wanted to discuss is consumption, FMCG, consumer staples, discretionary, all of this space as well. I think when we spoke to you probably was around the budget, and that time, we were discussing that April onwards is when things will start to move in. The tax cuts announced will finally find their way into the hands of the people. And now there are interest rates also coupled. So both fiscal and monetary policies looking at boosting consumption. Is this a space that interests you, and how would you really identify the right pockets to be in?
See, FMCG and consumption are the reflection of the economy. So last year in September, October, when the Nifty topped out at 26,000, it is in the FMCG space which actually led the downside, and the index saw a 20% fall in a matter of 4 months, which you rarely see in the FMCG index. I mean, we saw all the stocks, pretty much collapse. So it was a reflection that there was a genuine slowdown in the economy. Now, I think the FMCG index seems to have based out and it's attempting to recover, but the result season so far hasn't gone off so well. So I don't think you can thumb the table and say that the economy is back on track. I think that will be too early to say. We need to wait for a quarter. But because the price action discounts things well in advance, I'm tempted to believe that gradually FMCG stocks will start doing well from here. So it's not my favorite sector, and I think there are still risks because of the situation economy is in. But another sector that we like in the same context is NBFC. because after the budget and after the RBI policy, there is a very clear sense that, these companies are going to be lending a lot more. Valuations are very comfortable. And we've seen what Bajaj Finance has done as one of the star performers of the last 5-6 months. So NBFC, I think, is a space which we continue to like. And we believe NBFC can do what railway has and defense has done in the last 2 years.
Can it still go forward? I mean, 9,000 plus levels, 30% of a spike on Bajaj Finance. Do you still see a lot of upside there?
I think so. And I think it's one of these, there is sector tailwind. Valuations are still comfortable. There is earnings stability and visibility. And some of these companies are, a lot into AI. And I think a lot of these companies will definitely take great benefit out of it. As they say, the winner takes it all. So I think the top companies in these spaces will do very well.
Top companies in this space can actually do very well. Okay, you did say that, you would like to just be cautious on auto space at large. A lot is happening and, we've heard what has happened with M&M and the acquisition of SML Isuzu there. So just as a basket, if you could help us understand how are you looking at the scenarios play out here. Ather Energy IPO is coming in today. So the EV play is getting, hot in the space too. Maruti came into focus because of course, earnings dampener, but apart from that, management really talking about that they're looking at a slower growth pace in FY26 vis-a-vis FY25 as well, and how even the smaller car segments are getting more affordable for the unaffordable for the middle class. How would you look at what's happening in the auto space, and how should one really look at or re-look at the auto stocks that they're already in their portfolios? Tata Motors, for instance, how we've seen consolidation play out. There are so many moving parts here.
See, they've already corrected a lot. I mean, just to give you a data, while the bear market played out over 6-7 months, the average decline on the whole of NSE is about 42%. Now, this kind of a decline could have happened over 18 months. But because in today's world, everything happens really fast, you had this bear market play out over a period of 6 months. And in that period, grade A stocks stood out because that's where smart money or serious money was hiding. And anything that was slightly substandard saw a very large fall. In that context, if you see, auto also saw a very large fall in the last 5-6 months. But again, look at the context of the rise. M&M, Maruti, Tata Motors, TVS Motors, they all became multi-baggers in the last 3 years. And after a multi-bagger move, which was almost 2x to 5x, it's very normal to lose about 30-40% from the highs. So I think the downside is done with. Now, when the upside comes, I do not know. There is still no clarity. And because the upside potential is not visible on the charts right now, I'm not committing into them. But the key point is downside is not there, but don't commit capital into this sector right now because the opportunity cost is huge. You rather stay in financial services where there is a lot more clarity and lesser risk than committing into some of these sectors.
Right. So from here on, if I have to ask you, so far large caps have led the way in the recovery. How would you look at mid and small caps? Is it still a no-go area?
See, in the last 2.5 years, you could buy anything and you made money. It was that kind of a market. I think that has changed. So the trend has changed. The easy money making phase is gone. The men have been separated from the boys. A comment which I keep making, for the last many months now. So it's going to be a very real market and returns will be a lot more hard work. But I do believe large caps will do well, but they will not generate great alpha. Because on the index, if I have to give you a potential upside target, say for the next 6 to 12 months, I will talk about 25,500. Now that's about 7-8%. So in percentage terms, it's not great. And I think the top 100 large caps in India, will not give you serious returns. They will do well. They'll give you your 7, 10, 12, 15%, but they'll not give you supernormal returns. On the other hand, top quality mid caps and small caps will stand out even now. And this is a structural trend which started 3 years back and it continued. And now with the refinement that you saw with this bear market of the last 6 months, a lot of quality stocks are available at good prices. So the key point for your investors, quality mid caps and small caps will still generate alpha, and you should definitely look at topping into them and committing largely into them.
Okay, so top quality mid and small caps can actually continue to generate alpha for you. You really have to get down to understanding those select stocks. You did say 25,500 is what your target is over the next 6 months, is it? So you are actually falling short of the pre-levels that we saw, 26,277. We are not going to be retesting that, is that it?
Yeah, so number one, we've already rallied 2,500 points. So I think the
Yes.
market has already done its first leg of the move. Now, I think if the move continues, which I think it will gradually, we are getting to 24,800. So that's the next stopover number. And beyond that is 25,500. But the reason I'm not so excited about index view and index levels, because I don't think index is important. The next 6 months is about ignoring the index, being in the right stocks, being in the right pockets. If the
Perfect.
index is range bound also, it's a great environment for stock picking, which I think is the case for the next 6 months.
Okay, point taken. And now coming to your own firm, you're saying that Goldilocks is a global research firm now. Tell us what are the trends that you're looking at globally at this point in time? If as an average retail investor who's looking at, beyond the boundaries as well to probably create that well-diversified global portfolio, what would you advise, sir?
I think it's very important to have a globally diversified portfolio in today's world where there is so much happening. We have seen the fact that gold and silver has demolished equity market returns in the last 12 to 15 months. I think this is a trend which is here to stay. I think gold and silver will do bigger things. Gold is slightly toppish for the short term, but if I have to take a 18 to 24-month view, I think it'll do really big things. So we at Goldilocks Global Research, we believe that there are so many asset classes available and so many countries available for investment. So why just restrict yourself to one particular market? It could be why just India or why just US or why just Europe. So we've just taken a very global framework to our approach. And in fact, I now advise on some of the US stocks as well. So I look at Apple, Amazon, and Alphabets and Netflix on a daily basis, which is actually quite exciting. So I think as a global investor, you could be deploying some capital in commodities. It could be oil, it could be gold, silver, and definitely some investments in the US market is also recommended. In fact, if a market like China were to come back after 15 years of underperformance, which I think is likely to happen over the next 12 to 18 months, it's an opportunity you cannot miss because the Chinese markets valuation wise is almost mouth watering. And if you really compare that with the US and India, I think there is a big China trade which is coming over the next 12 to 15 months.
Okay, fair point. We'll actually delve deeper into it in our next conversation as well. Many thanks, Gautam, and it's always a pleasure to really listen to your fantastic insights that really go a long way in helping our viewers identify the right strategies for themselves in the long run. Thank you so much. Appreciate your time and congratulations to you yet again on the global, firm. And of course, we will be discussing more global aspects with you going forward.
Thank you so much. Pleasure.
Thank you. And with that, viewers, we wrap up our special series on Market Masters today. But as we continue to discuss more about what to expect from the markets, how to strategize your strategies, then stay tuned on to Business Today Television. Throughout the course of the day, we're getting you fantastic insights from the world of earnings. And of course, top market experts are guiding you through how do you well identify your right strategy in the current realm on the scheme of things in the stock market. So stay tuned. There's a lot more for you to really catch up on. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, Daily